There's a lot we can say about savings accounts, such as why you need to have one, how to grow one, and savings mistakes to avoid. We can even talk about the different types of accounts to have. But as we have these discussions, without thinking, sometimes we might use certain words interchangeably when describing different funds, which is something I see often when people talk about rainy day funds and emergency funds. I have to say, I have definitely made this mistake in the past. I cannot tell you the number of times I will be giving advice or tips on how to grow an emergency fund, and in my mind, that's what I'm thinking about. But so often I will accidentally say rainy day fund and I don't catch myself. But it is something I'm working on, because as much as people like to think that these accounts are one and the same, they actually aren't. They don't serve the same purpose and they don't hold the same amount of money, which is actually need to know information, which we will get to in a moment. So now that we have that out of the way, what is the difference between these two? Life is unpredictable and things don't always go our way. So it's not a question of if something will go wrong, but rather when. And when the unpredictable happens, having cash available is a good feeling because it can ease some of the stress. And in the simplest term, a rainy day fund is money that's specifically earmarked for smaller unexpected expenses. These are those one-time surprises that can temporarily throw off your budget. These might include a minor home or car repair, a speeding ticket, an unexpected bill, or it might be something else like suddenly having to go out of town. And some expenses are on the lower end where you might pay $50 or so, but others aren't, so you can easily find yourself having to shell out hundreds of dollars unexpectedly. And when that happens out the blue, you might not have enough cash in your everyday budget to take care of it. And if so, that's where a rainy day fund comes in, because you can take money out of that fund, take care of the issue, and that's without having to use a credit card or robbing Peter to pay Paul. So in a nutshell, this is money for a short-term crisis, which is a crisis that doesn't lead to financial ruin, because once it's covered, you can quickly move on. And I know some of you might be thinking, what's the point of having two? And if you like keeping things simple, it might make more sense just to have one pot for everything that can happen unexpectedly. But to answer that question, you first have to understand the actual purpose of an emergency fund. Because whereas your rainy day fund is for a short-term setback, your emergency fund is what keeps your head above water during a major financial crisis. And by major, I'm referring to unexpected events that don't have an immediate solution, such as a job loss, reduction of income, a serious illness, or another big hardship. These types of problems rarely resolve themselves overnight. They can drag on for months or even years, and some people lose a lot in the process. So it is so important to try and have enough cash on hand to specifically address these issues if they were to happen, because that could be the difference between staying afloat and losing your home. For that reason, you don't really want to get into a habit of tapping your emergency fund for smaller surprises. If possible, you want to maintain a minimum 3 to 6 months of living expenses in this account. That's the general guideline, but some people might prefer more, such as 3 to 6 months of income. So if your living expenses are $2,500 a month, that's at least $7,500 in an emergency fund that you only touch during a major financial event, and a great place to hold this money is in a high yield savings account. And as far as your rainy day fund, a good range is between $1,000 to $2,000, and you can also keep this money in a high yield savings account, or you can put it in a regular savings for quicker access. And personally, I think it's best to keep these funds in two separate accounts so there's no accidental dipping. But if you prefer a single account, some banks like Ally will allow you to split your savings into different savings buckets. So that's all that I have for you guys today. Don't forget to like, comment, and share, and also subscribe if you like personal finance and you want to see more videos like this. I typically post every weekend, so thank you again for watching, and I'll see you in a few days.